Okay, I'm very excited to be talking once again with Christine Benz. She was recently on the show. She spoke to us on the last episode about ETFs and mutual funds and index funds with a background working at Morningstar, where you can find a lot of her work at morningstar.com. She's also the author of 30-Minute Money Solutions, a step-by-step guide to managing your finances. I want to move beyond that last interview, which you can all hear online, to discover what should people really be doing who want to build wealth. And Christine, one of the things that a lot of people say is that in the stock market, it's not just buying stocks that grow in value, it's collecting dividends over time. Is this true, or is this kind of a myth?
No, I think that, when you look at market history, dividends are certainly a really big component of market returns, and estimates vary about just how much of the market's returns dividends have contributed, but it's high. It's as much as half of the market's long-term total return. So investors should, I think, squarely have dividends in their sights when they think about building their portfolios. Whether that should be their focus to the exclusion of all else, I don't really think so. But I think dividends are certainly a big component of what investors should be looking for when they're building equity portfolios.
What about in terms of kind of a low interest rate environment? How does that affect what's going on with dividends of stocks, and should people be worried about that?
Well, it has created a problem for people who were kind of the mind that they wanted to try to subsist off of whatever income that their portfolios kicked off. So whether interest income from bonds or dividend income from stocks, the fact that interest rates have gone down so low, that's really created a problem, especially for bond investors or investors who were trying to eke out a living with cash investments. It's kind of sent every bond investor out on the risk spectrum. So my thought really through this whole environment has been, let's take a step back and just think about building a portfolio with the best combination of risk and return characteristics given the investor's time horizon. So if an investor is retired and actively drawing upon that portfolio, let's not get too hung up on whether we pull the cash flow from that portfolio from bond income or from dividend income or from periodically scaling back really appreciated parts of that portfolio. Let's not worry too much about the specifics of where we go for the income. Let's just build a portfolio with the best risk return characteristics that we can identify.
So how do you explain that to a client? My day job is that I'm a financial advisor, so I talk to people about long-term financial plans and help them to develop investment portfolios, and I try to do exactly what you're saying. The problem is they'll often quote their grandmother who said, earn enough money, put it in the bank, and just live off the interest, but never, ever touch the principal. What do you say to someone like that?
Exactly. And I think of, my grandparents who were able to do just that. Unfortunately, the fact that bond yields, that interest rates have gone so far down, it's really changed the calculus of retirement planning. So one framework that I often talk about, and I think very intuitively illustrates a sensible way to create cash flow in retirement, is to think about the bucket strategy for retirement planning. So the basic idea is that you are segmenting your portfolio by your expected spending horizon. So if you're retired and you have money that you expect to spend within the next couple of years, well, you really can't afford to take much, if any, risk with that portion of the portfolio. So you've got maybe 2 years worth of portfolio living expenses in cash instruments, so some type of very safe account that really has very limited chance of losing money. And then you just step out a little bit on the risk spectrum from there. So when I think about maybe years 3 through 10 of retirement, you might have high quality bonds, you might have a little bit of high quality dividend paying stock exposure. And then for years 11 and beyond, that's where you can gun for some growth. You can own primarily stocks, you can own growth stocks, you can globalize your equity portfolio a little bit. That's where you're taking risks because you have a long enough time horizon to put up with some of the volatility that will inevitably accompany the equity investments. When people think about equity returns, they might say, well, equity returns are always better than bonds and cash. And the fact is that's not necessarily the case if you have a short time horizon. So you want to make sure that you have at least a 10-year time horizon for the equity piece of your portfolio.
There certainly is a lot of risk. We're learning about risk today from Christine Benz, who in the past served as Morningstar's Director of Mutual Fund Analysis. She has a broad depth of knowledge in terms of the financial industry, not only as an expert at Morningstar, but also in talking to regular people about investing. But sometimes the language, Christine, that people use, you got to wonder about. And I'm going to ask you back about something you just said. You said a moment ago that based on the low interest rate environment, we're seeing kind of a change in the calculus of retirement planning. And what that sounds like to me is that people who once thought they would just live on, clipping coupons, literally live on the interest from their investments, now they have to take more risk. Is that just a euphemism for, okay, guys, sorry, things don't look like they used to, and now you've got to put more money in the market if you want to be able to live the lifestyle that you expected you'd live?
Yeah, I think that that's a true assessment, that it's sometimes been called the war on savers. The fact that we've seen yields drop globally, and that has affected people who are attempting to construct retirement portfolios. Unless someone can subsist on a 1% yield on some sort of very safe guaranteed security, they've had no choice but to venture out on the risk spectrum. So it's a fact of life of the low yield environment. On the other hand, low yields aren't all bad, in that if you have bond investments in your portfolio, you have actually benefited, because when yields go down, that means that bond prices go up. Now, that trend may be reversing before our very eyes, at least here in the US, but it's certainly been a phenomenon that even though it's kind of taken with one hand as yields have dropped, bond investors have actually benefited as bond prices have gone up.
But as we say, past performance is no guarantee of future returns. And that's really something that might be happening, because presuming that rates are so low now, it looks like the only way they can go is up, although I'm not predicting that, because certainly some European countries have had negative interest rates. Assuming that interest rates go up, people who own bond, not individual bonds, but bond funds, what can they expect?
You can expect to see a little bit of price volatility with your fund. So even though your yield goes up, which is generally a good thing, you may see some price declines in the value of the bonds in that portfolio. The reason is that when higher yields come online, other investors say, well, I don't want your old bonds with low yields attached to them, and those might be some of the bonds in the bond portfolio. They say, I want some of these new higher yielding bonds. So that has a depressive effect on already existing bonds with lower yields attached to them. I would say, though, that investors should bear in mind that even if we have, say, a fairly significant jump up in interest rates, not just in the US, but perhaps in other parts of the world as well, that investors may not suffer the sorts of declines that they might be envisioning. So I think investors think that if we have this interest rate uptick, that it's going to translate into some sort of market shock like we sometimes have with the equity market. I don't think it will be anything nearly as extreme. In fact, when I look at a lot of some of the core type bond funds that investors own in their portfolios, I would say they have durations, which is a measure of interest rate sensitivity of roughly 5 years, yields of maybe 2.5%. The losses that an investor might experience in such a product might be like 2.5% in a 1-year period in which rates jumped up by 1 percentage point. So keep it in context. Don't run for the hills and assume that just because rates are going up, that will translate into catastrophic losses for your bond portfolio.
Just to go over that math, or actually the calculus as it were. So you're saying that a 5-year bond, a bond with a duration of 5 years, if interest rates go up 1%, it would be expected that bond would drop by about 2.5% over the 1-year period, let's say, that bonds increase?
Right. So assuming the product had a 2.5% yield currently, you might expect, so you're subtracting that yield from the duration, and the amount that you're left over with is roughly the amount that you would expect to see the product lose in a 1-year period in which rates jumped up by 1 percentage point.
Mm-hmm. So based on that, it sounds to me like you would feel it's okay for even retirees, let's say, to own bond funds if they don't want to pick individual bonds, or if they don't have enough money to diversify, or even if they do have enough money to diversify a bond portfolio, they still might be better off using a bond fund because of the professional management and the diversification. So you're saying then they shouldn't panic if they think interest rates are going to move up at a reasonable pace. Obviously, if rates were to go up by 3 or 4 or 5%, I assume that's a different story.
Yeah, that's exactly my viewpoint. I do think a professionally managed product can make a lot of sense for exactly the reasons you cite, that professional management as well as the ability to diversify. I think that that's something that smaller investors might struggle with. A, picking bonds in the first place, and B, adequately diversifying not just their issuer specific risks, but also the interest rate risks. I think it oftentimes, especially if you're not paying too much for the professional fund management, that's the way to go for smaller investors.
Okay. All right, Christine, this was a fantastic discussion. I'm so glad we had you back on the show. But unfortunately, once again, with so much more to talk about, we are out of time today. So tell me in the last few seconds, how can people follow you and follow your work?
I write a lot about retirement planning on our website, Morningstar.com. I also do a lot of videos with my colleagues as well as people outside of Morningstar.
Okay, we will put links to that at the show notes of today's show at goldsteinongelt.com. Christine Benz, thanks so much for your time.
Doug, thank you.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.